Austin, welcome to the show.
Yeah, thanks for having me.
Thanks for being on. Would you just mind letting everyone know who you are and what you do?
Sure. Yeah. So my name is Austin Preece. I am a financial planner. I own my financial planning firm, Preece Financial Planning. I started it actually in 2023, but I've been a financial planner my whole career. It's what I love. I absolutely love helping working individuals and families, typically ages 25 to 45, make sure that they're checking all the boxes when it comes to planning for retirement and other things throughout life.
So what motivated you to go off on your own and start this?
Yeah, a big part of it is I wanted to work with kind of a different demographic. A lot of advisors out there, they are really trying to work with retirees. You get to your 60s, you decide to retire, you roll over your 401k, they manage it for you and do some financial planning for you. I enjoyed doing that work. I enjoyed working with retirees, but I find that the questions and the problems that people who still have plenty of years left before retirement, their situations are a little bit more interesting to me. And there's kind of a need out there for that age group, because so many advisors are out there trying to work with retirees. So that was the main point, in addition to, as a lot of your listeners know, having a little bit more control as a business owner is always a goal as well.
Yeah, for us, it's usually, I want to make a bigger impact. I want to work with individuals, specifically and choose who I work with and for. It's huge. And I know today we're going to dig really deep into one particular topic that you cover. I know this is not the exclusive type service that you offer, but you brought this up to me when we were talking, and I was like, we have to do a whole episode on this, and it's HSAs. So very basically, I want you just to explain to everyone what an HSA is and what it's for.
Sure. Yeah. So HSA stands for Health Savings Account. So at the very base of it, it's an account that you can use to save for medical expenses. And that can be anything from out of pockets for doctor's visits to prescription medications to even Medicare premiums. When you're retired, you can use an HSA for those expenses. Not everyone is able to contribute to an HSA. You have to be enrolled in a high deductible health plan. Often those are connotated as HDHP. You might see that out there. And basically what that means is your deductible has to be, for an individual, at least $1,600 for 2024, and that changes every year. And then the out-of-pocket maximum has to be less than $8,050 for 2024. So there are some rules around the type of health plan that you need to be on in order to have access to an HSA. But having access to an HSA is a really great thing because there are a lot of unique benefits to them. They're often referred to as triple tax advantaged. Basically, what that means is when you put money into an HSA, you get a deduction on your tax return. You can allow the money to grow inside the HSA before you spend it, and that growth isn't taxed. And then as long as your withdrawals are qualified, as long as you're using them for health spending or medical expenses, those withdrawals are completely tax-free. So really great accounts to save on taxes all around.
But there's got to be limits on what you can put into them, right?
Yep, absolutely. Yeah. So the limit for 2024 is $4,150 for individuals, and it's double that for families. One interesting piece of it is family is a little bit different. The definition of family is a little bit different when it comes to filing your tax return as opposed to health insurance, right? If you're single and you have a child on your high deductible health plan, you qualify for that family HSA contribution. So really important thing to know. People over the age of 55 can also add an additional $1,000 to their HSA. So there's that catch-up contribution. And just like with IRAs and 401ks, just a little bit different because it's age 55 instead of 50. The IRS doesn't like to make things too easy for us.
I know. Oh, tell me about it.
Yeah.
So you mentioned that, so we have the limit there. Now you said it can grow tax-free. Let's talk about how does it grow in the HSA? Like you put it into the HSA savings account, is it earning interest? Can you invest it? Let's talk about that. How does it grow?
Yeah, good question. And this is where I start to get a little bit excited. I sometimes, I'm a little bit of a nerd when it comes to HSAs, and I absolutely love talking about them. So you often will have the ability to invest your HSA. It depends on where you open it though. So that's a really important piece. A lot of people have access to HSAs through their employer. And most of those plans will allow you to invest any balance over $500 or $1,000. And they'll have an investment lineup just like in a 401k for people to choose from. If you're not contributing to an HSA through an employer, which I know a lot of the listeners here maybe are self-employed and are not contributing through an employer, you get to choose where that HSA is. You don't need to have it through a business. It can just be an individual plan. And most banks and credit unions will open one up for you and probably pay a little bit more interest than other accounts that they would open. But you are able to open an HSA at a brokerage, like Fidelity, for instance, is one that offers HSAs. And then you're able to invest in stocks and bonds and money market funds, to allow that money to grow. As many people know, with Roth IRAs that grow tax-free, we want those to be very growth-oriented so that you can get a lot of tax-free growth. We want a lot of the same stuff with HSAs. We want to get that money to grow tax-free as much as we possibly can. There's a little bit more of a balance because you might have health expenses crop up that you're going to want to use your HSA for. So it becomes a little bit more nuanced when investing in HSA.
So there's a couple of things I wanted to unpack there. So one is that you can contribute to this as an employee of a company, but also as a self-employed individual, right? Is the only requirement to contribute that you have a high deductible health plan, whether that is self-employed health insurance or through some other type of provider?
Yes. Yeah. At its base, that's
right.
what the requirements are. It has to be a high deductible health plan, and you can't have any additional coverage that isn't a high deductible health plan. So
got it. So that has to be the only plan.
Yeah. That's where some people get tripped up. Maybe one spouse has a high deductible health plan, the other spouse has family coverage on a plan that's not a high deductible plan. No one can contribute to an HSA in that case.
I gotcha. Okay.
Yeah. Another thing to note is, unlike IRAs, you don't need earned income to contribute to an HSA. So it's great for years that maybe the business is showing a loss and you don't have profit showing. Of course, you wouldn't necessarily need a deduction at that time anyway, but you can still fund these.
So let's take a sidebar there. You say you don't need earned income to contribute to an HSA. Can you just unpack what you mean when you say earned income?
Yeah, so earned income is really, for business owners, it's going to be anything that you have that self-employment tax on, right? Anything that is a result of you doing work to earn it. So some people think, well, I'm earning interest in my bank accounts. Well, you're not really doing anything to earn that income. So it's important to know that even if you don't have that earned income that you're working for, you can still make HSA contributions.
So it's kind of like the antithesis of passive income, right?
Yep. Yeah.
Okay. Cool. So, so you can have earned income, or excuse me, you cannot have earned income and still contribute to an HSA. So if you're making money through, is earned income real estate, like rental income?
Right. Usually no,
okay.
It could be, right?
Right. Though, yeah, there's nuances to that. That's a bad question,
there is, but
there's nuances, but yeah.
Yeah. If you have a couple of rental properties and that's where your main source of income is coming from, you can still make contributions to an HSA. And, if income is coming from, retirement accounts or an annuity or something like that, if you don't have income from anywhere else, you can still be making HSA contributions.
Okay. And let's talk about, so you mentioned that we can only use it for qualified expenses, which y'all, we can Google what qualified expenses are. I'm sure there's a laundry list of stuff that we qualify, right, for certain types of health related expenses. Right. But what I wanted to ask you, Austin, is about how retirement accounts have a required minimum distribution, or you have to start taking money out. Do you have control on when? It feels like it's a more flexible account in that you don't have to wait till retirement to use it. It's not a retirement vehicle, but it might be a way for people to save money tax free and be able to call on it if they need it. Is that a correct assessment of it?
Yeah, absolutely. And there aren't any required minimum distributions, right? With a pre-tax IRA, it's, what, 73, 74, 75 is when you need to start taking money out of those. With an HSA, no requirements to take money out. It is, I think, important to note some of the penalties around, if you're taking money out that's not for qualified expenses, right? For normal retirement accounts, it's typically a 10% penalty. For HSAs, the penalty is a little bit higher. It's 20%. So that's important to note. And then they're also not that penalty lasts until age 65. So
Okay.
before age 65, you can take money out of an HSA and use it for any qualified medical expense. Once you get to age 65, you can still use it for qualified medical expenses tax-free. However, if you have a bunch of money in your HSA and you're just not going to have enough expenses to take it all out tax-free, you can use it just like a pre-tax IRA. So any withdrawals no longer have that 20% penalty, but you are going to be paying income taxes on any of those withdrawals age 65 or later.
I see. Okay. Well, for some people, the 20% would be better than the income tax rate, right?
Well, the 20% is in addition to whatever your income tax
So there's
rate
penalties
is.
and interest. Okay. So there's penalties and interest if you take it out too soon or if you use it for it's not too soon. Take it out and use it for the different expenses.
Right. Before age 65, it's whatever your marginal income tax rate is plus 20%. So
Got it.
For a married couple making $150,000, your marginal rate is probably in the 22%. So if you're taking money out of an HSA for non-qualified expenses, you're going to be paying 22% plus the 20%. So almost half of that is gone before you use any of it.
Got it. So there's your incentive. Okay. I was going to say, I was like, you could probably hack that. 20% is actually better than the tax rate.
Yeah, not quite.
All right, cool. So, okay. So basically for HSAs, I think that a lot of people, maybe they're listening to this and they're going, how did I not know about this? Like, why was this not a thing that like they gave us in the pamphlet? You know what I mean? Like, why is this such a well-kept secret? Because I know people know about retirement accounts. They've heard 401k, they've heard Roth traditional, they've heard IRA. I feel like this gets a little bit of this like underappreciation because a lot of people don't talk about it and how it can be used. Why do you think that is?
Yeah, that is a really good question. I think that part of it is probably, as long as your income is under a certain dollar amount, anyone can contribute to a Roth IRA, right? So it's pretty widespread as long as you have earned income and you're not making over the income limitations. And pretty much anyone who has earned income can contribute to, anyone who has earned income can contribute to an IRA, right? So I think that part of the reason is probably that there are less people who have high deductible health plans who are eligible to make these contributions. So it doesn't get quite as much attention. Anyone who's writing or talking about it isn't necessarily reaching as wide of an audience as if they're talking about Roth IRAs.
That is true. Yeah. And I think that, and for those listening who are self-employed, right? Chances are, I'm just going to paint the scenario, right? Let's say you leave your corporate job and you and I were in this position too. You leave your corporate job and you go, crap, health insurance. Like, so, crap, we can need health insurance. That's one of the first thoughts. I think that's one of the biggest things holding me back where I was like, but like, I have to pay for my own health insurance. Like, it's this weird feeling of like, this is the big jump, right? And it's so damn expensive on the open market to get a health insurance plan that people, especially healthy individuals, like for example, with me, my husband and I are very different in terms of like our doctor visits. Like I go to the doctor once in a blue moon. Like I never get sick, knock on wood, but I'm perfectly comfortable with getting a high deductible plan, knowing that I may never really need the amount of coverage that it would cost me otherwise. So I'm inclined to go for that type of plan, especially as a self-employed individual, because I go, it's cheaper. Like the actual premiums are cheaper, the higher the deductible in general. Yeah. So I can imagine a lot of people listening are like, when they're going through open enrollment and they're going, I like that when it's cheap and the deductible's high. And it's like, okay, I'll roll the dice. And what you may not realize, guys, is there's a benefit to that. And I think that has to be considered and something we're talking about this time of year when we're going into open enrollment. Do you agree?
Yeah, absolutely. And Insurance is always kind of a conversation about, what's the benefit versus what am I paying? And you'll find sometimes just because of how much lower the premium is for that high deductible health plan, even if your medical expenses are hundreds of dollars this next year, you might still be saving money by paying for the expenses out of pocket and paying that lower premium. And in addition, you're going to have access to an HSA, which is a great tool. I will say that for people who have health plans that are not high deductible health plans, they may have access to a flexible spending account, which is similar, where you're able to put pre-tax dollars into it and use it for qualified expenses. There's a health FSA and there are different types of FSAs. So you can put in pre-tax, use it for qualified expenses. But the difference is at the end of that year, that money is gone. Some of it might be carried over, $600 or so might be carried over into the following year. But basically the rule is if you don't use it, you're going to lose it. It's a use it or lose it plan. So that's one major difference between having a higher benefit health plan versus having a high deductible health plan and having access to an HSA.
That's really good to know too. Yeah, I used to use an FSA when I worked at the firm, and it was like a race to figure out what I could spend at CVS with my FSA.
Yeah.
Because I was going, okay, what else can I use this for? Because I have this money in the account. It's like a gift card that was going to expire, right?
Exactly.
It's like, okay, what else can I buy with this? What else can I buy with this? I'm trying to play beat the clock over here. Yeah.
Yeah. Not only that, but then determining how much you're going to put into it. You
right.
don't want to put $3,000 into an FSA if you're going to use $200. You're going to get a $3,000 tax deduction, but you're only saving your marginal tax rate. And if you're not using it, you're losing it, like I've already said. So.
Yeah, exactly. You're locking it up too. So I would put in like a little bit, because I said I'd just take the discount, if you will, as opposed to tying it all up in there.
Right.
It's like giving yourself a coupon for later.
Yeah.
So, okay, that's awesome. So we've got HSA, FSA, all this stuff. And I'm sure listeners have heard these terms before and probably gone, they always feel inaccessible. They always feel like, oh yeah, an HSA, I probably don't qualify for that. Or I probably don't, like, if you don't know what it is, it probably sounds too complicated to participate in. So based on that, if someone's listening to this right now and saying, you know what, Austin, I love this idea. So you're telling me I can put money in like up to maybe $4,000 ish this year, or this coming year, and I can be able to let that grow tax free, everything that you just said. How do I start that? Where do you go? Who do you call? What website do you go to? How do I click start my plan now?
Yeah. So like we mentioned, if you're married and one's a business owner, one works at a company, there might be access to an HSA through work. And that often is a really good way to make HSA contributions, because as an employee, if you're making HSA contributions through payroll, you're saving the FICA taxes, the Social Security and Medicare taxes that add up to 7.65% of your paycheck. You're saving that as you put into the HSA in addition to your marginal tax rate. So if you're in the 22% tax bracket, again, you're not only saving that 22%, but you're saving an additional 7.65. So that can be a really great way for people to contribute if they're employees where they have access to an HSA. If you don't have access to an HSA through work or as an employee, you can go to a bank or credit union, and most of them will be able to open one up for you. And there are also online brokerages that you can start an HSA through. So you have a lot of options for getting one open. It's just a really great thing to get started so that you can get that deduction, get that growth, and tax-free withdrawals for medical expenses.
Awesome. So as people are entering into, it's the end of 2023, beginning of 2024 right now, as people are entering into open enrollment season, which I also, by the way, side note, I think it's hilarious that we have like one shot at like open enrollment for health insurance plans. I think it's silly, but we're entering into, it's almost like registering for classes in college. It's like, okay, it's the time. Yeah. So people are entering into that season, and maybe folks are newly self-employed and they're having to register for the first time and sign up for health plans, or they're refreshing their own plan for their company or as an employee or an employer. So here's a question. Who is there to help them? Who is the right person for them to call when it comes to choosing a plan that can also factor in the stuff that you've said? Because I don't feel like we have a ton of help out there broadly on how to even interpret these different health plans, let alone how an HSA should fit into thinking about that.
Yeah. So I would say a couple of things. If you're self-employed, you're probably working with a health insurance broker. They're going to have a wealth of information on different considerations to think about. I think what a lot of people don't do that they could be doing is maybe having a conversation with their doctor about, what are the risks of me being on this high deductible plan? Are there things that I'm not thinking about that I would have to be paying for that doctor, whatever, about that I'm not going to be thinking about, so
right.
that can be very important, as well as, always, if you're working with a financial planner who knows your whole situation, they're probably one of the best people to ask and can walk you through all of the considerations that you should be thinking about.
Yeah, absolutely. So how would you recommend people approach that conversation with, say, a financial planner?
Yeah, I mean, you should be able to just reach out and say, hey, I have these options. Can you help me evaluate them? And from there, any financial planner should be asking you a bunch of questions, right? If anyone tells you, oh, always go with this without asking you anything, unless they happen to, be your brother or something, maybe take that with a grain of salt. But provide as much information as you can and work together to analyze the different options that you have, and they should be able to help you get to your best option.
Fantastic. And let's just say somebody doesn't have a financial planner on their side. How could they find out more information from you and your team on how they could take advantage of this?
Sure. Yeah. So my website is preecefp.com. So it's PRECE. F as in financial, P as in planning.com. If you go there, you'll see a couple of buttons on the homepage. One says start a plan. Anyone who wants to start working with me, that's their first step so that I can start getting the information that I need to provide valuable advice. And that's absolutely free for anyone to go ahead and start their plan on my planning software. Right next to that button is a button that says book a consultation. So if there are any additional questions, that'll take you right to my calendar to schedule a virtual meeting with me, and we can talk over whatever other questions you may have.
Amazing. And, thank you so much, Austin, for sharing all of this with our listeners. I know that this is not always the most approachable topic for people, and it's hard to get really good, clean, and simple information about this stuff without ending up down an internet rabbit hole of jargon and a lot of stuff. So what would be your simplest piece of advice to those listening who are intrigued by this and want to start saving using an HSA?
I guess the simplest piece of advice would be check what health plan you have. And if you're on a high deductible health plan, then either, like I said, through your employer, set that up during open enrollment, or at any time, just go to your bank and ask them if they can help you set up an HSA. They should be able to do that. For people who may be listening in early 2020, one thing to note is if you're going to go open an HSA at your bank, you can even still make a deductible contribution for your 2023 tax return before the tax filing deadline. So last piece of information that I think is important.
Yeah, a little bit of, guys, there's very few opportunities that after the ink is dry for 2023 to actually change the end of the story. And that's one of them. So there are some instances where you can actually change the outcome of 2023 and reactively tax plan. Very few opportunities. I always say proactively tax plan, but if you can always do this as well. Now, really quick question on that, Austin. Do they have to have the HSA set up by the end of the year and they can contribute by the tax deadline, or they can legit set it up in 2024 and retroactively apply it?
If you're able to get it set up on April 14th and contribute on April 15th, then you're able to retroactively apply any contributions.
Okay, technical question. What if they extend?
If they extend, then no. That deadline is April 15th.
It's April 15th, regardless if you have an extension on your return. Got it.
Yeah, the only thing that I'm aware of that extending helps you with is a SEP IRA contribution to...
Correct. Yeah. I knew that was the case for SEP IRA, and I'm like, is this play here too? I'm actually genuinely curious, guys. I'm asking these questions. I'm not even being like, what is it, like rhetorical? I don't know the answers to some of these questions. So this is actually really helpful for me. Austin, thank you so much for sharing your knowledge with everybody listening, including myself. And one more time, how can they find more information about you and schedule a time to talk to you?
Yeah, go to preecefp.com and either click on Start a Plan and I'll reach out, or click on Book a Consultation.
Amazing, guys. Go take those links in the show notes. And Austin, thanks again.
Thank you.